All week, investors were counting down to the UK general election result and the latest jobs data from the US and Canada. Well, all now have transpired, and as part of our events coverage, Andrew Grantham joins me down the line. Andrew, 223,000 jobs added to the US economy. Wages are moving higher, but not at the rate a lot of analysts would like. Sure, the headline figure for the US was better than expectations of the last few days, but can investors really breathe a sigh of relief that March was an anomaly?
I think what today's figures suggest is that the March data that we had was a bit of an anomaly, but they also suggest that we shouldn't expect to be returning to the 250, 300,000 payroll gains that we'd kind of become accustomed to before that as well. We're kind of settling somewhere in the middle, and I think that's what we should really expect going forwards. The US at the moment, the unemployment rate is so low, and workforce growth is only bringing in about 100,000 new people to the labour force every month. So we don't really need blowout job figures to keep the unemployment rate moving lower. I think market reaction and the Fed's focus going forwards will be more on the wage figures. And it is a bit of a surprise that we're still seeing some very muted trends in wages. We were expecting something slightly better, and the 2.2% annual rate that we had is still within the broad range that we've kind of been stuck in really ever since the recession ended.
And Andrew, what did you make of the Yellen tantrum effect in terms of risk during the week? And to your mind, how do today's figures feed into the suggestion of a September rate hike?
I think a September hike is still on the table. It would be surprised, given the figures that we've had recently, if they were to move before that. Certainly, we've moved our own expectation back to September. And for them to move in September, we are going to have to see some clear signs that growth has rebounded following that Q1 disappointment. And we do think that there's certainly some room for consumer spending to drive a rebound in growth during the second quarter. And also, as we mentioned earlier, we are going to need to see some increase maybe in wages or some increase in other inflation measures for the Fed to be reasonably confident, as they put it, that inflation is going to return to their 2% target over time. We do think that there should be some more wage pressure coming through in the months ahead, but to be honest, we would have said that a couple of months ago as well. It is seemingly taking a bit longer to come through. September's still on the table, that's still our call, but that's probably the earliest that they'll be moving now.
Canada lost 19,700 jobs in April on the biggest drop in part-time work in 4 years, reflecting the damage to the economy caused by the collapse in oil prices. But what's next for Canada, and how do you see the loonie trading moving forward?
Yeah, I think the Canadian figures, you mentioned that the headline job losses there. If you look at the detail, it wasn't quite as bad. There was some increases in full-time work. A lot of the negatives were in part-time and self-employed. So the composition of that report, and given the fact that it is a very volatile figure, meant that the report wasn't too bad. We do think that there's still a little bit more negatives to come from the decline in oil price in terms of maybe some further job losses coming through in provinces such as Alberta and Saskatchewan. We think by mid-year the unemployment rate nationally could be up to around 7% from the current 6.8. So we do see a little bit of the negative still to come through from lower oil prices. But the Bank of Canada, in terms of their forecasts for Q1 and Q2 certainly have set a pretty low bar. I think Governor Pollers is now very much willing to sit on the sidelines in terms of policy. So we do think that the loonie could trade a bit weaker against the US dollar in the months ahead, but that has more to do really with US dollar strength as the Fed maybe hikes in September rather than any necessarily weakening in the Canadian outlook.
Yields in the US 10-year actually dropped, and the dollar's knee-jerk reaction was very short-lived after the data. Do you think we could see a behavioural change in the sterling US dollar now that perhaps sterling can be taken off the sidelines? What are your forecasts?
Yeah, I mean, I must admit, kind of going into the UK elections, we were actually worried that the market was being a bit too complacent about the possibility of a clear-cut election result in the UK. We thought, sterling had been rallying beforehand, and we thought that if there wasn't a clear-cut result, which looked kind of odds-on, really, looking at a lot of the polls beforehand, that sterling could actually weaken. Now, the fact that we have a slim conservative majority, by the looks of it going forwards, I think, our forecasts and maybe a lot of people's forecasts for sterling are going to change going forwards. That also means the fact that we have more political stability is that kind of brings the Bank of England maybe back into line to maybe even hike rates this year or at least early next year, which could be before the markets are currently pricing in. So, our forecast was a little bit negative on sterling in the near term, but I think given the election results, we can be a bit more positive going forwards now.
Well, that's all from Andrew and myself for today. Thanks for watching and tune in again next week for more of the same. Goodbye.